"24 seconds away from the opening bow this morning. Good morning to you. This Wednesday morning, here's the price action. We erased some of the losses from earlier on, post those headlines from Ursula von der Leyen out of Europe. Futures basically unchanged. We're positive 0.05% on the S&P on the Nasdaq 100, up 1/10%, leaving behind a really strong day of gains yesterday. Look at the build on them this morning. Switch up the board and get to the bond market. All morning, yields lower on a 10-year, much lower by 5 or 6 basis points to 296.15. The euro all over the place, going into a crucial 24 hours for this ECB. What on earth are they meant to do tomorrow? Euro dollar 102.32. We're positive there 0.05%. The dollar just about weaker for a 4th straight session, and crude negative 1.5%, 102.65. We're down about $1.60. About 25 seconds into this one, we're pretty much dead flat on the S&P. Let's get you some movers. Here's Taylor Riggs.
John, there are some movers underneath the surface. I want to start with the trio of downgrades over at B of A. Some of the network stocks, Juniper, F5, Arista Networks. The analysts saying, of course, that investor expectations not aligned with the forthcoming deterioration in the financials. Juniper, as you can see, they're off about 2%. ASML, sort of the chip-making company, big miss in terms of cutting the sales forecast, saying that there's some huge supply constraints that still exist. Citigroup, though, coming out saying that visibility does remain strong, though, for this company into 2023. Netflix, we've been talking a lot about it, but erasing some of the big moves that we had post-market after the bell. I'll kind of leave it there. It's a stock that's gone from 700 to 200. Market trying to figure out the fair value of the stock. Finally, Tesla, of course, is going to be the focus after the bell today. Not only the distractions from Elon Musk, but maybe some of the fundamentals, the COVID lockdowns, and of course, some of the big costs to ramp up all of that production.
Taylor, thank you. Should we get you some more from Shanali? We can do that on the big bank, sparking the biggest 2-day rally for the S&P 500 since 2021. The financials ran in for 3 days. Hey, Shanali.
John, just how far we've come just in a couple of days here. You have Goldman Sachs, for example, since the end of last week, leading the pack with an 8% gain in its stock. And that is more than 4 times what you're seeing in the S&P 500 in that time period. And you're seeing other financials also get a lift because, as UBS's Selena Marcelli says it is not a plunge, it's a slowdown you're seeing in the earnings here. And you see that slowdown right there. So even though that slowdown is happening, the reason it's not really spooking investors, as you know, sometimes a reset in valuations can be very welcome. You had Goldman Sachs' John Waldron just speaking to Bloomberg Television yesterday saying it's important to reset the price of money. We've been living in a very unnatural environment for some time now. David Solomon just earlier this week talking to investors about how that resetting that price of money might be a little bit painful in the short term, but at the end of the day, once investors get used to that new price of money, you can see activity start to resume again. So as you see there, yes, banks have really sold off in the first half of the year. You have Goldman Sachs, Wells Fargo, Bank of America now comfortably above book value with this recent gain in their stock prices. Remember, heading into earnings, they were trading below. Maybe that is fair value, John.
Shanali, thank you. Distracted by the price action and Netflix right now. Forgive me, Shanali, but thank you very much. We're basically unchanged on the morning, about 2 or 3 minutes into the session. This tweet came from Casey Hunt, a CNN anchor. Covers politics here in America. Here it is. Re Netflix. I feel like markets could learn a thing or two from political reporters who become master detectors of BS expectations management. But what do I know? I mean, think about it. We were guided to a loss of 2 million subscribers and they delivered a loss of 1 million subscribers. That is hopping over a very, very low bar. These problems are going absolutely nowhere. Let's get some more on this. Let's get to Kelly Lyons. Hi, Kelly.
Hey, John. Well, it seems that investors were kind of realizing that this morning with the stock well off its pre-market highs, barely clinging on to a gain here because, as you say, the news wasn't as bad as it could have been, but that doesn't mean that the news was great because they still lost almost 1 million subscribers in the second quarter. Nonetheless, what's interesting, while Netflix hasn't been able to hold on to those big gains it saw earlier on, some of its peers in the streaming space have been able to do so. Disney, Paramount Global, each up about 1% here. And the thing about that subscriber number on the headline, yes, 1 million losses. When you look beneath the surface regionally, they actually did lose 2 million subscribers in the US, Canada, in EMEA. What came to the rescue is the Asia Pacific, where they saw additions of about 1 million. So that helps them on the pure subscriber line, but when you have the rescuing coming from foreign markets, John, then you start to deal with the FX headwinds. And as a result, Netflix reported $430 million lost due to FX, specifically a stronger dollar in the quarter. And of course, that isn't a Netflix-specific story. So far this year, as we've seen the dollar rallying up about 9% on the year, stocks with foreign exposure have actually underperformed the S&P 500. The S&P Foreign Exposure Index down about 20% year to date. And what are the largest weightings within that index, John? Apple, Amazon, Microsoft, all of the tech heavyweights that we were reporting next week. And of course, we'll be watching for any FX commentary in those results.
What a week we've got coming up, Kelly. Looking forward to your coverage of it. Kelly Lyons with us all week as well on Bloomberg Surveillance with Bramo out of the building. Bramo's going to be back next Monday. This from BlackRock's Gargi Chowdhury. Gargi saying this: central banks are reckoning with a trade-off between tamping down inflation and destroying demand, thereby increasing the risk of recession. Whatever happens, our view is that the market risks are set to rise and investment horizons are likely to shrink. Gargi joins us right now. Gargi, your line and your message over the last few weeks, why you think we need to live with sustained inflation. Just build on that for me.
Sure. Hi, good morning. Good to be here. So, we've spoken about this before, this idea that inflation, while it may not last at today's 9.1% headline levels, hopefully, it's certainly not going to go back to the pre-pandemic period of sub 2% or around 2%. And honestly, what we're recognizing now, especially when we see the data, and we saw that in CPI earlier last week, is that the deceleration is probably going to be a little slower than what we had originally anticipated. And what we're seeing now in the data is that the strength is coming in some of the more persistent sectors of inflation, some of the more low volatility part of the CPI component. So shelter inflation, for example, once that starts moving up, it continues to stay high for some time. So back to our mid-year implementation guide that you were talking about just a second ago, all of that points to inflation remaining above the 2% level that we were used to for so many decades for a couple of more years to come. And that's why investors need to think about how to hedge for that higher inflation regime.
One way of doing that is through tips, obviously. A question that I've asked before, I'll ask it of you, Gargi, is a bet on tips a bet against the Federal Reserve?
So, there's a few different ways to think about this. Number one, when you think about owning tips, it's obviously you're getting duration. There's real duration associated with owning tips. And obviously we know what's happened to interest rates. Real interest rates have gone from a negative 100 basis points to about a positive 50, 60 basis points, depending on where you look at the curve, or even higher as you go further out. So part of the message that I have had for investors is when you're looking at tips, be very cognizant of the real duration aspect. And if you expect inflation as well as interest rates to keep moving higher, hedging away your interest rate exposure. So having that exposure to pure inflation. What we're actually telling clients more and more now is to play for the very front end of the tips market. So really looking over the next 2 to 3 years instead of the full benchmark. And shorter duration tips, or STIP, what that gives you is that front end inflation. Now, you asked a really important question around, is it betting against the Federal Reserve? I wouldn't put it that way. I think the market's already, what we're seeing right now in the inflation break-even markets is that there is no pricing in of inflation spiraling out of control. There is a lot of central bank faith on them being able to control inflation right now, which I think is good. We want to see that. But I think we might have moved a little too far, especially in the 2-year sector. So having some allocations to inflation-linked bonds in the very front end of the curve versus a nominal counterpart makes a lot of sense.
So Gargi, elsewhere, not just break-evens rolling over, copper down over the last few months, crude down, gasoline down. I know you think supply shortages are here to stay. Can you build on that theme and tell me that if this inflation story rolling over to the extent that it has done is a bit of a head fake, where else would you look to pick up the pieces?
Sure. So, to your point, obviously we've had some of that demand destruction and some of that has come in the commodity space, and obviously crude comes to mind. And that probably is one of the reasons that, we have a little bit of comfort of headline inflation coming down from these very elevated levels. But some of the other ways that you can sort of think about how you can position yourself for some of the shortages, both in the short term and in the medium term, obviously the war has brought about some shifts to how we consume goods and services and how we will for some time. And where I have spent a lot of time thinking about is actually the food space, right? So we've looked at food CPI, we've looked at what's happened globally. Sri Lanka comes to mind when there is food insecurity, and allocating towards longer term trends, which companies that are looking to alleviate reliance on traditional food, and we have an iShares sticker for that, iVeg, which really looking at food, sort of plant-based proteins, things like that, which are still, I would call it, emergent technologies within the food space. I think that makes a lot of sense. And obviously the energy space as well. Look, obviously commodity prices are lower right now, but some of the demand supply that has led to energy prices being where they are haven't gone away. And I think when that reinserts itself, when the economy globally fully reopens, I think investors need to still find some refuge in energy companies that are going to benefit from structurally high energy prices much above the pre-pandemic levels.
Gargi, I was also going through your research and you brought up the geographic bet that's a part of all of this, and what popped up was Mexico and Brazil. Why those two countries?
Just in terms of if you think about which countries are going to benefit from commodity exports, which countries are going to benefit from this friend-shoring concept, and the word obviously taught to us by Janet Yellen, those are the two that come to mind. And we think that, again, investors, especially if you're an investor that's looking at the fixed income of those countries, I think it makes a lot of sense. So it's a commodity story. It's also a friend-shoring story. I mean, we're all talking about supply chain disruptions. We're all talking about supply chains being more resilient going forward. We're talking about supply chains moving away and coming closer, whether we want to call it onshoring or friend-shoring. And what are some areas of the market that can benefit from that? Certainly Mexico is one.
If those two countries are a buy, is China a sell?
I think there's obviously, we've seen recently some regulatory news that has come out. I would also say that there's a huge amount of focus on cases and COVID cases going up, to what extent the country can really effectively vaccinate the elders within the country. And I think those are signs that we're watching. Obviously, if we see a great amount of vaccinations taking place and COVID cases continue to drop, I mean, that bodes very well for China, but that's currently not the case.
Gargi, awesome to catch up, as always. Gargi Chaudhry there of BlackRock, breaking down her views on inflation. It's here to stay, and why she still has that position in tips, and why she thinks you should too as well. We look ahead to next week with big tech earnings on deck. Apple at the back end of the week. I talked about those analyst calls on Apple a little bit earlier this morning. Let's face it, the price target cuts down to 180. 180 is still pretty punchy, but the direction of travel is clear over the last couple of weeks. Morgan Stanley come down to 180 from 185. Wells Fargo comes down to 185 from 205. And the key theme here, foreign exchange, pops up in both of these reports. This from Wells Fargo. Overall, we see a worsening COVID situation in China and beyond, a deteriorating macro environment, increasing FX impacts as the biggest risk to near-term estimates. On foreign exchange, Julian Emanuel of Evercore had this to say. The strong US dollar has emerged as yet another issue for companies with international exposure. IBM and J&J both flagged dollar headwinds, echoing Microsoft's prior warning. Julian concludes by saying this: can FX damage be relatively contained as an extended dollar shows signs of peaking? If it indeed has peaked, Morgan Stanley are looking for 112 on the dollar index, which means some big upside from here, given that we're just short of 107 at the moment. That's a story to watch into next week. Story to watch right now, coming up down in DC, President Biden turning his focus from inflation to climate change.
The president is committed to taking aggressive action to tackle climate change, and made clear if the Senate won't act, he will.
That conversation up next.
The impacts of extreme weather are intensifying across the globe, including here in the United States. No one is immune from climate change. The President is committed to taking aggressive action to tackle climate change and made clear if the Senate won't act, he will.
President Biden announcing climate change action today in Massachusetts. This is falling gasoline prices, ease pressure at the pump. The White House running in a news release the following. The president will deliver remarks on tackling the climate crisis and seizing the opportunity of a clean energy future to create jobs and lower costs for families. Anne-Marie joined us down in D.C. for more. AMH, tell me what's going to happen today.
Well, the president's going to outline some plans, Jonathan, things like bolstering the wind industry, offshore wind industry, also maybe directing some more funds to communities that are trying to build resilience to natural disasters. But he's not going to go as far as declaring this a national emergency, which would give him access to more than 100 powers. National emergency, when that happens, it's the likes of a hurricane or a terrorist attack. And the president would have these broad powers to move a lot of different directives to fight climate change. That could be on putting more money into renewables or stopping the exports and transport of some fossil fuels, even stopping some oil drilling. So they're not going to go as far as that, but it means they're still weighing it. But they're really walking a delicate line because, of course, they're making this statement off of the heels of what happened last week, which is Senator Manchin saying he will not sign up for those provisions to fight climate change and tax hikes, but they still need his vote, of course, in a 50-50 Senate to sign on top of other legislation they're discussing in the healthcare space. So he will outline plans that they're going to take, but they're not going to go the furthest they could today. But he will say it's an existential threat.
Do we have a coherent energy policy down in Washington?
Well, it's difficult because on one hand, the administration has released all of this oil from the Strategic Petroleum Reserve. They talk about how this is historic in what they've done, and they are talking to American oil and gas producers to pump more, given what is going on with prices and a global energy shortage due to Russia's invasion of Ukraine. And Russia, of course, is a third largest producer. At the same time, this is a president who wanted to be a climate president. They came in, they made a lot of executive actions to make sure that they were putting whatever they could in their stakes in the climate industry, and now they are dealt with the reality of higher gasoline prices. So they're trying to weigh both at the same time.
Which makes that visit to Saudi Arabia that little bit more embarrassing, Anne-Marie. So run me through things from the president's perspective. When will we see if he gets what he wants to see in August from OPEC Plus? What does that look like?
Well, in August, what the Saudis are saying is that they need to go back and look at also supply and demand of the market right now. One, do they think that the market needs more oil? Because remember, if there's more oil in the market, you also have to find a place to refine it. And right now, that's probably one of the bigger issues in the market, which is refining capacity. And then the spare capacity for that is in China. The second thing, of course, is that the Saudis right now are pumping a little bit under 11 million barrels a day. They could go to 12. The UAE also has some, but together it's a little bit under 3 million barrels a day. So it's not a ton that they can even give to the president if they wanted to. So it's a tricky situation going into the winter. And Jonathan, this is in America. It's going to be much more acute in Europe.
AMH, good to catch up down in D.C. on the latest. Anne-Marie, thank you. Back with us at the top of the hour, we get some housing data. I wanted to touch base with Mike McKee ahead of that. Hey, Mike.
Well, John, we've talked about this before, the impacts on the overall economy from housing. As you know, mortgage rates have been going up, getting nearer and nearer to that 6% mark again. And this week we saw housing starts drop. And then this morning we got a report that mortgage applications are down to their lowest level in 22 years. Hard times for housing indeed. And there's a gloomy outlook. The number you mentioned, existing home sales, comes out at the top of the hour, expected to be down over 1% after a 3% decline last month. We get new home sales next week. They bounced last month a little bit, but are expected to be down 3%. So what does it all mean? Well, this is something the Fed is keeping an eye on, because if we continue to see home sales drop, it means we're going to see jobs lost in the housing industry. I just picked home construction workers there. You can see they have only just begun to drop off. If that goes much farther, then of course this spreads throughout the housing industry, and it's bad news. You remember last week Chris Waller said he's watching the homes numbers before the Fed meeting. None of the numbers that we've gotten so far are going to make him look for 100 basis points.
The question I keep getting, Mike, is when we start to see some of this show up in rents, and maybe show up in core inflation too in a more material way?
Yeah, unfortunately, it takes a long time because the way they measure these things is they ask you what you think your home would rent for. And at this point, that takes months to get in because people don't buy homes every day. So we're going to be looking at inflation from the home prices that are up for quite some time, although we will be watching the existing home sales and new home sales numbers to see if median prices finally start to fall.
Are you saying we've got to find a better way of measuring this stuff? Because I feel like that's been the story for a long time now, Mike.
People have been saying that for a long time, but they haven't come up with a better way yet.
Mike McKee, good to catch up. The data at the top of the hour. Mike will break that down with Guy Johnson and Alex Steele. Guy Johnson, no doubt, will be looking at what's happening in Italy, a real turnaround in the Italian debt market. Yields were lower, now they're higher. They're just one part of the recipe, one ingredient for a messy recipe for Europe going into tomorrow with the ECB on deck, Italian politics in focus, and the big unknown, how much energy comes from Russia into the continent. Up next, we'll get you the trading diary and count you down to a monster 24 hours in Europe. From New York City, this is Bloomberg. And 25 minutes into the session, equities down just a little bit. We're down 0.1% on the S&P. On the Nasdaq, we're positive, firmer by 1/3%. Just for a moment, it looked like Netflix might roll over. That's positive just about in the early part of this session. A little bit later, we get more tech earnings. On to next week. That's where your big week comes up after Tesla. We'll hear from Facebook, we'll hear from Amazon, Microsoft, Apple, all of the above. That's the price action. Let's get you to the trading diary. Existing home sales at the top of the hour. Mike McKee will break that down for you. President Biden discusses the future of clean energy at 2:45 Eastern. Tesla reporting results after the closing bell. We're still calling that a tech firm. Great decisions from the ECB and the BOJ on Thursday, plus another round of initial jobless claims. And finally, US PMIs rounding out the week on Friday here stateside from New York City. Looking forward to a big day in Europe tomorrow. I'll cover that with you. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, July 20th. Here are the top market stories we're following for you at this hour. Capitulation or no capitulation? Investors and strategists debate the bottom. Economists debate where the Fed's neutral rate is. We debate peak pessimism. The next test for the housing market. Mortgage applications sink to as rates rise. We're moments away from the existing home sales data. We dissect the industry with Howard Lorber, a Douglas Elliman chairman and CEO. And Putin's new ultimatum. The Russian president pledging gas to Europe if certain conditions are met, while Europe proposes a 15% cut in gas demand as it prepares for a winter without Russia. From New York, I'm Alex Steele with Anna Edwards over in London. Guy Johnson is off today. Welcome to Bloomberg Markets. Anna, the news coming fast and furiously. It's really hard to know how we're going to be taking it. Is all the bad news kind of baked in, or do we need to prepare for things like the gas not returning for a more hawkish ECB?
Yeah, absolutely. Certainly sitting here in Europe where so many of this week's uncertainties rest, it would seem a big call to know the answer to that question. There's been so much going on today, Alex, and sentiment really ebbing away from these markets the further through the U.S. session we get.
Yeah, and let's get the existing home sales data. That's just breaking right now. They fell about 5.4% in May. That is a two-year low. Borrowing costs are surging, affordability is plummeting, and we're looking at how existing home sales, the likes we haven't seen since June of 2020. In June of 2020, I feel like no one was buying any kind of house because of that pandemic, Anna. So another sign of the housing market continues to roll over, which in theory is what the Fed wants. Just how much slowing do they actually want from it?
Yeah, absolutely. So the weak data, the bad news around the housing market in the U.S. continues to come through. The negatives surrounding the gas story in Europe also continue to come through. We've also got a red headline surrounding Germany. That reads that almost 5% of the German economy is at risk over Russian gas. This is a warning from the IMF. So the IMF adding their view to the pile as to just how much weakness there could be in Germany. The country should be open to more spending, the IMF says, and mitigating measures can still soften the blow. And we have heard a little bit about German efforts to try and persuade people to use less energy, and certainly there's an EU push, an EU-level push here. And even though President Putin has said most recently that he will turn those taps back on, we know that the EU is making a lot of plans that assume there will be no further flows of gas.
And Anna, all this really points to the fact that have we just seen all the bad news come out? If we get the taps turned on tomorrow, even at 20 or 30%, are we not at all priced for that? The same thing happened with Netflix, right? You had the numbers were so grim going into it, the stock had been so pummeled that it didn't really take that much to beat and have that stock rally.
Yeah. Yeah, absolutely. So in a number of different contexts then, whether we're talking about corporate earnings, geopolitics, where we are in stocks, let's get to our question of the day. Are we at peak pessimism? And maybe this varies depending on which of those assets you're talking about, or maybe it varies depending on where you are in the world, because things might seem different sitting here in Europe as they do in the United States. Let's talk to Bloomberg's Mike McKee and Katie Greifeld, both joining us to talk us through their thoughts on this subject. Mike, let's come to you first. We just broke yet another set of housing data that, well, you give us your take on it. Certainly the read into this had been negative around housing, but you do have to ask, given how negative it's been, whether we are at peak pessimism.
Well, from an economic standpoint, it's really hard to tell you, and I don't want to sound like a two-headed economist, but there are things on both sides that you have to consider. That's the tough job for the Fed. Now, we saw for the fifth month in a row existing home sales fall. This morning, we saw mortgage applications fall to a 22-year low, and yet median prices for existing homes continue to rise. So that's still inflationary, still going to feed into the inflation numbers. That's the hard part about trying to figure out what's going on here is we have inflation and a slowing economy, a bit of stagflation at the moment. And how do you respond to that if you're both the Federal Reserve or an investor?
Yeah, and on a market level, you know, Katie, we're looking at the S&P over that 50-day moving average. Yesterday's rally was fairly broad-based. We're a little softer today. Note after note says we are at full capitulation or not at capitulation. It's really hard to understand positioning in light of that.
It is, and I mean, we're not going to really know whether this is
the peak fear moment until, we're well down the line. But if you look at some of the notes coming out this week alone, you have Bernstein saying today Bank of America was wrong. Yesterday they had come out and said that we're seeing full investor capitulation now. But Bernstein saying, actually, if you look at the equity fund flows, both on a mutual fund and an ETF level, they're still sitting on net inflows of hundreds of millions of dollars. So at this point, we haven't seen sort of the money come out of the market that would mark that peak capitulation. But if you look at other sort of measures of cash, for example, there's definitely still a lot of fear out there.
Mike, coming back to you, I mean, so much of this might depend on your view as to, are we nearly there yet when it comes to the Fed narrative? We pushed it a good deal over recent months, and we got to the point where we were asking, are we going to get 100 basis points? We've dialed that back a little bit. But until we have a good, full sense of just how far the Fed goes, and I've seen different terminal rates being thrown around, some as high as 5% over the last 24 hours, until we get a good sense of that, that's so crucial to where we go on other assets. Maybe it's difficult to know if we've reached peak pessimism.
Well, absolutely, because the question is, does the Fed go too far? Do they push the economy into recession? And there's a growing feeling that they're going to. There have been always pessimists about the Fed's ability to do this, but now we're up to about a 40% chance of a recession according to the Bloomberg economics model. And yet at the same time, analysts have only just started reducing their earnings estimates for next year. And a lot of people wonder if the analysts are the ones that are behind the curve now. If they come way down, then maybe that tells the market to sell off a little bit more. We don't know.
Yeah.
This is all up in the air. And unfortunately for everybody involved, we don't have the data looking forward.
But that also brings up the question, Katie, of what we saw with Netflix, right? Like estimates were so low, it didn't have to necessarily do much then to see a stock rally. And I'm taking into account Apple, Wells Fargo, Morgan Stanley, they trimmed their price forecast. They're looking at deteriorating macro environment, the FX impact, meaning that we're going to quickly downgrade earnings expectations right into the numbers, which then really sets up the companies then to rally.
Theoretically, I mean, that's what you're seeing with Netflix, not as bad as expected. That might be sort of the mantra as we get into the real meat of earnings season. But, I mean, to Mike's point and your point that estimates are finally coming down into the numbers, I mean, can they come down fast enough to sort of set up that positive surprise? It remains to be seen. And just coming out of bank earnings, for example, very, very mixed. So whether we do get that positive catalyst from earnings remains to be seen. We have the big headline tech numbers coming up next week, really. So it's going to be an important few weeks to actually determine whether we are at that sort of peak pessimism level.
Right. We had a really interesting just micro story around this narrative earlier on in Europe with ASML. They put out numbers, big suppliers to the chip industry. Big disappointment at the headline level as to what they're announcing about their full year. And the stock rallied, and you just wonder if there were more, if we hadn't seen peak pessimism, perhaps there'd be more room for that kind of news to spark a sell-off. But Katie, that's sort of the more fundamental side, thinking about where we are on earnings. What about the technicals? What do the technicals tell us about whether there is room to bounce here?
Well, Alex mentioned that 50-day moving average on the S&P 500. We did bounce above it yesterday. It looks like gains are fading today, but that would be important if we remain above that because we've been trading below it since April, really when last earnings season kicked into gear. And then if you look across asset, really, you did see some buy-in to the risk on sentiment. You saw junk bonds rally yesterday. You saw even crypto get a bid. You haven't seen that in a while. So it feels like there is some sort of setup here for a sustainable risk on move, but I think a lot of it is going to come down to earnings. And when you come to that technical picture, that 50-day moving average is important as well.
And before that, we got to get through the ECB tomorrow, which is going to have a huge impact potentially on yields as well as the FX market, euro dollar. All right, guys, thanks a lot. Really great setup for us today. Bloomberg's Michael McKee, Katie Greifeld. Thank you very much. Coming up, we're going to get more on the question of the day. Are we at peak pessimism? How do you trade it? We're going to break it down with New Edge Wealth CIO Cameron Dawson. This is Bloomberg.
earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projections, that is the story.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I still think that all the talk about whether we're in a recession, I happen to think we are, is of secondary importance. What's of primary importance is inflation. If it doesn't come down, the Fed's not going to stop, and in a recession, I don't think it's going to stop them.
That was Jim Bianco of Bianco Research on the state of the U.S. economy, which takes us to the question of the day: are we at peak pessimism? I want to ask Cameron Dawson, New Edge Wealth Chief Investment Officer. Cameron, the reason why we got to that question was because I feel like every economist now is increasing what their neutral rate is going to be for the Fed. And then all the earnings expectations are slowly starting to roll over now with a little bit more gusto, but the positioning is already pretty thin. Are we at that peak pessimism level?
Yeah, the challenge with looking at sentiment and thinking about peak pessimism is that it is a really poor timing tool for market behavior. We can see extremes in pessimism really persist for some time. So think about retail investors being very bearish all year and yet the market keeps going down. And so it doesn't really help us predict 1 year forward returns, but it can be helpful looking 3 to 5 years out. Now, it is helpful to see that we have some positive reactions to negative earnings surprises. This means that people were kind of already on one side of the trade. They already became too bearish or too short in their positioning. But the challenge is, even with things like the banks or names like Netflix, is a lot of them are still in very distinct downtrends. So you can see a rally off of maybe an oversold level, but if you're not starting to recover and break into a better uptrend, it really remains to be seen if this can continue. So it's more of a relief at this point and not necessarily a trend change.
Cameron, well, that's depressing. It's a poor timing tool, and it can endure. It can last for a time. So we'll keep that in mind as we feel very pessimistic this afternoon here in Europe. It was interesting to hear that little clip there of Jim Bianco talking about how he thinks we're already in a recession. I spoke to Holger Schmieding from Berenberg Research in Europe earlier. He was talking about how he thinks Germany's already in a recession. Is that important to you, where we are not in recession, in terms of how you're thinking about the markets, thinking about timing tools?
Well, it certainly is important because it has a big impact on earnings estimates. And yes, we have started to see earnings estimates come down, but it is only just slightly. We're still at 10% growth for this year and 9% growth for 23 and 24. That does not feel like equity analysts are pricing in a recession. And it's easy to say that all of that upside in earnings is coming just from energy. But if we look at other cyclical sectors, things like tech, still up 14% for 2022. Industrial still forecasting 28% growth, and consumer discretionary still forecasting 21% growth. That does not feel consistent with a recession. Now, it is a good question whether we're in one already or not. It's likely we get those 2 consecutive quarters of negative GDP growth, but that may not be enough for the NBER to call it a recession, given the fact that the labor market and things like retail sales consumption is still holding in. So we'll see if we get that official recession call despite the 2 quarters of negative GDP.
So to that point, you look at the NASDAQ 100, it's up about 0.5%, helped by Amazon as well as by Netflix. So I'm wondering, if you go into the recession, you don't want to be owning industrials. That's going to have a lot of earnings downgrade. So at what point do you need to rotate back into growth, because growth will be scarce, which basically means big tech?
Yeah, this is a really important question because tech has morphed over the past few years from being a cyclical industry, one that was sensitive to CapEx cycles for companies because companies had tech spending on things like hardware, to one that has appeared to be much more defensive because of this shift to recurring revenue and more software sales, as well as the dynamics around the pandemic, because the tech sector actually saw earnings grow during the pandemic, where even even other defensive sectors like utilities saw their earnings decline. So the question is, going into this recession, do your growth darlings, do your tech darlings have that same kind of earnings resiliency that they had during the last cycle? And I think that's being called even more into question with the announcements of delays in hiring from your tech giants like Apple, like Google, like Tesla. And I think that raises the question if they are as resilient this time around as they were back in 2020.
What kind of signs are you seeing amongst small caps, Cameron? Because I know that's one of the clues, one of the timing tools you do look at to see whether we are seeing a turn in these markets. Do you see anything any sense that small caps are getting excited?
Yeah, that's so important when we're coming out of a major market low to see risk on positioning really take a lead. We want to see investors clamor for risk, add beta, add that kind of risk-seeking behavior, and small caps are often a really good signal of that. Now, small caps actually made a low versus the market back in May, and they didn't make a new relative low in June. That's somewhat bullish, but I think the challenge for small caps is that if we look over the long run, there really is one key driver of sustained small cap outperformance, and that's liquidity, and liquidity that comes from the Fed. Small caps typically outperform at the beginning of an easing cycle. So any kind of rebound we have in small caps today could be short-lived as long as the Fed remains in this tightening posture.
Cameron, last question here from me. It's specifically related to earnings. Is this going to be something like a kitchen sink quarter? Do you feel like companies are just going to throw everything into it, everything bad they can possibly get out, so we can kind of find some kind of bottom, sentiment can be really low and then build back from there? And if that's the case, where would you be most constructive?
Yeah, that's a really good point. There was an article in your Market Lives blog today that talked about this is the quarter to do it. This is the quarter to kitchen sink because expectations are already so low. And so you have the opportunity just to get the bad news out of the way. I think companies could take that on. We'll see as we progress through earnings season. And then from there, the question of leadership really becomes what we think the liquidity environment is going to be and the direction of interest rates. We think that growth stocks, for example, we can't just think about the earnings resiliency. We also have to think about the valuation multiples. And as long as the view is that you are going to see higher real interest rates, those growth valuations, which are still trading at 60, 70% premiums to value, they still remain very elevated and at risk of further multiple compression. So there can be an opportunity to possibly add to some cyclicality, but it has to be very high quality. You want names that have good free cash flow generation. You want names that have good balance sheets. Given the liquidity environment, the time is likely not yet to turn to junk and really dumpster dive.
Okay, Cameron, thanks very much. Cameron Dawson of New Edge Wealth. Thank you very much for your time. Thank you for your thoughts. Coming up on the program, Bitcoin gains for a third straight day in step with a broader rally in risk assets. At least that was the case. Risk assets just unsure of themselves, it seems, right now. But Bitcoin gaining over the past 3 days. More on the crypto story next. This is Bloomberg.
This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Housing affordability is set to worsen to levels last seen early in the financial crisis. That's according to S&P Global Ratings. Rising mortgage rates are making high prices ever more expensive. By the end of this year, mortgage payments will make up 28% of income for the typical first-time buyer, the highest since the first quarter of 2007. For the first time, Cathie Wood's ARK Investment Management has pulled the plug on an ETF. Wood is closing her ARK Transparency ETF, which launched at the end of last year. The fund gained only $12 million in assets since inception, a fraction of the $9 billion in Wood's flagship fund. It was a rare passive vehicle from ARK. And Tesla reports earnings after the closing bell today, and the electric car maker's run of rising sales and profit is under pressure. During the second quarter, Tesla faced challenges including supply chain difficulties and lockdowns in China that hurt its ability to make cars. And that is your latest Business Flash, Alex.
All right, thanks so much, Ritika. So you're looking at Bitcoin actually managing to rally today over 23,000 despite a little bit of a softer market. So now the cool thing is to say that crypto winter wreckage is done and talk about the failures in risk management and the regulatory gaps, but then predict more stability going forward. That was the theme at yesterday's Bloomberg Crypto Summit. Galaxy Digital founder and CEO Mike Novogratz spoke to Bloomberg Shanghai Basak at the event.
What I don't think people expected was the magnitude of losses that would show up in, professional institutions' balance sheets. And that caused a daisy chain of effects. It turned into a full-fledged credit crisis, right, with complete liquidation and huge damage to confidence in the space, into the infrastructure of the space.
Bloomberg Shanghai Basak now joins us from that interview. Hey, Sonali, what was your biggest takeaway from talking to him? It's easy to say, I was wrong then, but I'm right now.
I think the other interesting thing was that he kept to his price target of $500,000 within 5 years. That would really be 4.5 years now. He made that price target earlier this year. You have to grow significantly to get there. Chris Nagy of Bloomberg has a really interesting column out today that Bitcoin has really made it when you stop really comparing it to other assets and say Bitcoin is worth a single Bitcoin. And I've got to say, even after this conference yesterday, I was at a separate conference over at Christie's, a lot of NFT people, and they were saying the same thing. The metaverse will have made it when you stop calling it the metaverse, when you stop comparing it to other things. So I don't know how long it takes to get there, but you do see Bitcoin charging higher today. You see it charging close to 24,000. The question is Novogratz right, and is all the leverage taken out of the system, or is there a new low to be reached in this crypto winter?
Yeah, Sonali, that's really interesting, isn't it? I mean, how many assets can really claim to be incomparable to other assets, or there's no point to compare them? I mean, the dollar maybe gets close, but even there. Let me ask you about something else related, though, and this is where we've seen the wealthy in the crypto space taking this crypto winter as an opportunity to go out and do deals, to find cheaper assets that are cheaper than they were at least. And I'm thinking about your big take story here on Sam Bankman-Fried.
Yeah, and I think what's interesting here, too, and this it was really led by Hannah Miller of Bloomberg as well. Sam Bankman-Fried's so interesting here that he even said that some deals that are going to be done in the industry really do place the question of moral hazard out in the industry. Should some things be left to fail? And it's interesting because there is a derivative play here. You're seeing Sam Bankman-Fried have some exposure to Voyager now, which has exposure as a creditor to 3AC, where there's a lot of questions about how that bankruptcy will play out and who gets paid and when. But Sam Bankman-Fried, like Mike Novogratz and like the SEC, the real concern here is not the investors, it's the consumers, because right now those protections, at least in some worlds of cryptocurrency, certainly more centralized versions, the consumers last on the credit spectrum there.
Quickly, and I know they're going to be talking their book, but do they feel like the worst has now passed?
They do. They keep saying so, but they've also said so before. I think we've heard something similar at around 20,000 when we've talked to Mike Novogratz as well. So, but 18,000 to 24,000. Again, I've covered this space since 2015. There have been other drawdowns before. The question is, if we stay kind of in this range, are we out of the woods until the end of the year?
Sonali, thanks so much. Sonali Basak bringing us the latest from that crypto event. I watched the Jack Mallers interview, the Strike founder. Really worth digging that out on the Bloomberg terminal. Really good interview with Matt Miller, our colleague. Now, don't miss Bloomberg Next Big Risk. Sonali spoke with Abby Joseph Cohen, Sam Bankman-Fried, as she referenced, and Ken Moelis. That's tonight at 9:30 p.m. They'll bring you the highlights of that New York time. This is Bloomberg.
All right, we're an hour into the U.S. trading session here. A rally taking up some steam here. We got NASDAQ 100 now up by almost a full percentage point. Thank you to Amazon as well as to Netflix. Bloomberg's Kriti Gupta is tracking some of those moves for us. Kriti?
Yeah, Alex, green on the screen here, which is interesting because it's kind of a turnaround from what we saw even just a couple of minutes ago. Remember, the market did open lower, a reaction, I would say, to the fast and furious rally of yesterday, up about 0.3%. But remember, a lot of this is going to be defensively led, and that's significant because breadth is going to be a major story. We're going to come back to that in a second, but you can see that defensive nature. The NASDAQ outperforming 1% higher. NYMEX crude, though, that risk-on move, well, it's not cross-asset at the moment. In fact, crude futures down almost 2%. We'll see if that volatility continues to the downside. Remember, we want breadth, we want yields higher, we want commodities higher too, to suggest that that growth story, that's what's driving the market instead of simply technical kind of bounce back. Even the 10-year yield really hovering around that 3% level. But for a stock's perspective, it really is all about the earnings story. And we've got a couple of them this morning. Netflix, of course, rallying. A less than bad, I think is the best way to describe it. Subscriber loss. The idea that, yes, we know subscribers are being, well, they're really being bled out in Europe and in America. But then if you look at, say, the emerging markets, Latin America, that's where you're seeing a lot of the growth. And that, of course, helping Netflix stock this morning. We should also talk about Abbott Labs here. The shares are down just shy of 2%. This comes after some mostly better COVID test sales. But once again, it's that warning outlook. As the COVID situation gets better, how much does that help their bottom line? And that's really going to be a big part of that story as well. Let's talk about Bath & Body Works. They cut their second quarter EPS estimate and their outlook. Remember, that has everything to do with consumer income. If you're concerned about recession, you're concerned about that ability to spend, Bath & Body Works is where it's going to show up. And let's talk about Baker Hughes here, 13% lower. This comes after they really take a write-down to shut off their Russian operations. And you can see that showing up on their bottom line. Let's go back to the dollar story, because that's going to show up over and over again in the earnings stories as well. You can see the dollar, it did weaken a little bit, coming back a little bit higher today. The question is, does it continue? The consensus trade at the moment is that dollar higher is going to be the norm from here on out. That being said, you are going to see a little bit of volatility as we've seen in the last 3 days. Does it, however, flow into the stock story? Lower dollar, weaker dollar stake, does that incentivize foreign flows into the stock market? And let's hit the home sales, the rate story as well, because that's really the last piece of the macro picture. Where you do see existing home sales, well, they're dropping. Is the housing market still as tight as we thought it was? That's going to be a big question as well, Anna, as we talk once again about the macro picture.
Yeah, absolutely. We're going to stick with that theme now. Bloomberg's Kriti Gupta, thank you very much for the update on the markets. Now, that big increase in U.S. mortgage rates keeps making homes less affordable, it seems. Sales of previously owned homes, existing homes, fell last month to a 2-year low. We're joined now by Howard Lorber, the chairman, president and CEO of Douglas Elliman, a residential brokerage company. Really nice to speak to you then, Howard. So are you surprised we see another set of data coming in weak on the housing market as rates continue to rise in the U.S.? Are you surprised at all by this data?
I'm not surprised, really, but I'm not so sure it has to do predominantly because of rates, because what we've seen as rates go up, that many times brings people into the market quicker, because they've always heard stories. If they're young, they heard stories of where rates were a number of years ago in double digits and so forth. I think that just the economic outlook and the inflation and coming up elections, I think they've lost money in the market. Mm-hmm. I think that's really more what's putting the damper on the real estate market at this point.
So, Howard, have we then accurately seen the impact of higher rates in the housing market?
Well, I think, if you think about it, whenever they talk about rates like recently in the 5s, those are pretty much 30-year, mortgages, conforming mortgages, which are on smaller numbers. But if you could still get adjustables in the 3s if you have banking relationships. And then, of course, the wealthy, it's pretty simple. Either they can pay cash if they don't want to sell anything from their portfolio because their stocks are down. They just go to their bank or their brokerage company, and they can borrow against their collateral for 150 basis points. So I don't, it depends what part of the market you're speaking about.
But thinking about mortgage applications, so away from the more luxury end of things, Howard, I suppose, thinking about mortgage applications, we saw that data showing a drop to the lowest level since early 2000. Yeah. I mean, I guess the Fed would like that to be, to some extent, to do with higher rates, because they're trying to slow things down a bit.
Yeah, it's definitely, it just has something to do with it. It has a lot to do with it, but that's on the lower end of the market, not on the middle and the luxury end, which we basically do most of our business on the luxury end. But we do watch what's happening. It is the lowest mortgage application, I think, in 21 years. So we obviously see that it's happening. And the question then is really, who is it happening to? And I would say that it's happening to the people that are buying at the lower end, what we consider the lower end of the market.
Let's go to luxury then for a second, Howard. Traditionally, particularly here in New York, overseas buyers, foreign buyers would come in and snap up New York City real estate, for example. But now the dollar is super high, and that seems to be a trend that could be softening. What are you noticing?
Yeah, no, we see that. We're sort of disappointed because we assumed that with COVID under control, we hope that we were going to see all these foreigners come into the market and start buying houses. And it hasn't happened. And it hasn't happened just because of what you said. With the dollar so strong, it's not going to happen. And so if it continues to be strong, I think we're going to have to wait until things straighten out in the world and the dollar goes back to someplace near where it was before. This is not good at this time for foreign buyers to come into the markets here. It is good for American buyers, dollar buyers, to go into the foreign markets.
Yes, certainly the weakness in the pound, weakness in the euro could be luring people. What about? I mean, maybe this isn't an area of the market that moves on this metric, Howard, because you've described where you operate. But looking at the rent versus buy decisions that people are making at this point, as rents continue to rise in New York, how does that look to you?
Well, surely the rents are going up, and they're going up in the low rentals, the middle, and the very high. And there's a lot of that, especially in the luxury markets, so rents. And the rental market is very strong, and there's actually a lack of inventory, especially at the high end of the rental market. And so I would imagine there'll be people that will decide, developers, that we're going to build a condo. Maybe now they're going to make it a rental. It's maybe easier for them to get comfortable and to get financing for it. But the rental market, at all ends of the rental market, is very strong and continues to get stronger.
Hey, Howard, so as we're all talking about recessionary fears, the Fed having to go to a terminal rate of, 4 or 5%, et cetera, when you look at all your data from rentals to the high-end housing market, what would stand out to you that says, yep, we are headed into a recession?
You know what? That's hard to say. I mean, most people that are around today, they just keep going back to 07, 08, 09. But that was a banking crisis, so it wasn't what we have now. And there are so many different variables now. The war in Russia and Ukraine, the interest rates going up, the inflation, the supply chain problems. There are just so many factors. I'm not an economist. I'm in the real estate business. So I can't tell you what's going to happen. And I'm not so sure you could get too many people to agree on what is a recession. I guess the predominant opinion is when your GDP goes down 2 quarters. Is that what's normal?
Yeah.
If that's normal, yes. that could very well happen. But what type of recession is it? It's not going to be 1928.
Okay, right. Well, let's all hope not. I mean, I wonder, something that isn't very 1928, Howard, is the phenomenon of work from home. And, of course, that has led to changes in the housing market and where you've seen demand for housing, both in the US and in lots of parts of Europe as well. How is that influencing where people are buying at this point, Howard, the working from home option, but also the pressure to return to office?
Well, the working from home option is not very good for the office real estate market, but it's very good for the home market. Because people, when they decide they're going to work from home or their employer lets them work from home most of the time or 100% of the time, they want more space. They want to have a room. They want to have their own office. And that really, and they want to be, in many times, especially when COVID was more active than it is now, they wanted to be in the country. They wanted to have land. They wanted to get outside. All the things you couldn't do in these metropolitan areas. So I think it's very strong reason for housing prices to go up in those type of markets. And we still see it. Now, they've gone up so fast, to be truthful, that I think they're going to have to start slowing down a little bit, because all the luxury markets and all the resort markets are really, like in parts of California, like in Aspen, like in Montana, all these places. And then the local suburbs like Westchester and Fairfield County, they've really gone up very fast, and they have been sort of not done anything in years. So they are shining right now.
Hey, Howard, really love catching up with you. I'm selling an apartment in the fall, so I really want to know everything that you say. We'll check back in with you in a couple of months on that. Howard Lorber, Douglas Elliman, Chairman and CEO, thanks very much. Some breaking news for you. The DOE inventory coming out at the bottom of the hour there. You get inventories had a draw about 445,000 barrels, but gasoline inventories saw a build. Gasoline demand revised higher, but gasoline inventories saw a build. So potentially some reaction to prices. Maybe we've we've seen really high gasoline prices. Maybe people are driving a little bit less, hence the inventory build. Crude off by about 1.6%. Now coming up, Netflix says, well, it could have been worse. Shares up after subscriber loss was less than expected, in part due to the success of Stranger Things. Details next with the tech guru. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. Rishi Sunak may end up on top today when Conservative members of Parliament vote to decide which two candidates will battle to replace Prime Minister Boris Johnson. Sunak finished first in Tuesday's fourth ballot. It's the battle for second that's heating up. Foreign Secretary Liz Truss is now the favourite to join Sunak in the final ballot. Vladimir Putin has signaled that Europe will start getting gas again through a key pipeline, but the Russian leader has some conditions. He says that unless a dispute over sanctioned parts is resolved, gas flows will be tightly curbed. The EU has proposed curbing gas consumption by 15% over the next 8 months. That's in case Putin cuts off exports entirely. Now, President Biden will announce executive action today to confront climate change. One provision would steer federal dollars to communities ravaged by heat. For now, though, the president is holding off on an emergency decree that would allow him to use sweeping powers against global warming. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. So Netflix lost almost 1 million customers in the second quarter, but the stock is up today, really helping to propel the Nasdaq 100 higher because it was less than half of what Wall Street actually feared. CEO Reed Hastings has a message for investors. It could have been worse.
If there was a single thing, we might say stranger things. But again, we're talking about, losing 1 million instead of losing 2 million. So, tough in some ways, losing 1 million and calling it success. But, really, we're set up very well for the next year.
All right, joining us now is Michael Pachter, Managing Director of Equity Research over at Wedbush Securities. He's an outperform rating on the stock and a 280 price target. Michael, always great to get your perspective. It's really good to see you.
Thank you.
Is it could have been worse enough to be positive on the stock right now?
Yeah, I think it is. If you look at, let's just look at the U.S. and Canada. They lost 1.3 million subscribers, and that's fewer than 2% of their total subscribers. They raised price by 10%. So if you kind of work through price elasticity of demand, that's pretty good. I don't think Netflix is yet ready to accept that they're in a slow growth, high profit mode, and they talked a lot about that on the earnings call and in the letter. But they are certainly managing the slow growth. They're cutting their costs. They're kind of pulling back on content spend, and they're going to generate a lot more cash. So that's really the reason I think investors are excited. Netflix is holding out hope that they'll return to hypergrowth one of these days, and they'll be positioned for that. But in the meantime, they're going to throw off a lot of cash, and that's good.
And good to speak to you, Michael. And the company didn't seem keen to think about increasing prices as perhaps one of the reasons they were losing subscribers, given the numbers you've just given us. Maybe you share their view.
Yeah, they I have to say they're somewhat delusional when they talk to investors and they drink their own Kool-Aid. They do a lot of things that really don't make a whole lot of sense. For example, dumping all their episodes at once, and Reed brought it out on the earnings call. We're committed to binge watching. That's our winning formula. It's kind of odd that no other service does it that way. Nobody. Amazon just tested it with the Terminal List. It's the first show ever that they dumped all the episodes. So why doesn't Netflix emulate the success of firms like HBO, who have a tenth as much content and yet have much, much lower churn? So, they don't do everything right, but the stuff they're doing right now is enough to make the stock go up.
Michael, your 280 target, does that value Netflix as a growth stock, or is that valuing Netflix as a slowing growth, focus on profit stock valuation?
It's a high teens free cash flow multiple, which means that I think they're going to grow pretty decently, but not 20% a year, 30% a year. More like 3 to 5% a year in revenue with some leverage. You get there, and that's above the market multiple, but not materially above. It's probably a 25% premium to the market. So I think they're better than the average stock in the S&P 500. They're not, Tesla going from 0 cars to 500,000 cars a quarter.
Okay, and is that change in growth expectations that maybe we should attach to this business, Michael? Is that because of something to do with Netflix and just how big they've become, or is it to do with the competitive environment? Because others have made the point that the competition, there's more of them, and they are better than they were.
Obviously, that's exactly the crux of the matter. If it were a zero-sum game, and if it were that Disney and Peacock were gaining share and Netflix losing share, then that would be accurate. It's not zero-sum. People are cutting the cord or shaving the cord. They're able to trade down to something like Fubo for $60 a month or YouTube Plus for $60 a month and trim their cable bill and supplement it with streaming services. So I think there's room for everybody to grow, but I think your point, Netflix is the biggest, therefore closest to fully saturated, is right. I have for 10 years said they were going to peak out, eventually, and that finally has happened. And my 280 price target is less than half of where the stock was trading 6 months ago. So I don't think they're going to 600. I think they're going to 280. And I think the guys who thought they were worth 800 were just flat out wrong. And they have to reassess now, is this a slower growth, highly profitable company?
Yeah, definitely worth that victory lap, Michael. I want to get your take on Amazon. I know you haven't put out your note yet on it, but we get earnings next week. That stock is up 3.5% today. It got upgrades there today from Jefferies, saying that in the back half of this year, the underperformance of Amazon will reverse, and that we're going to see profit improving and the top line improving and better growth and higher margin businesses doing better going forward. What do you think?
This is 2013-14 all over again. Bezos got distracted and decided to launch the Fire Phone, and it was an abject disaster. He took his eye off the ball and let earnings turn negative, and the stock got hammered. Jassy came in and kind of did the same thing, took his eye off the ball on retail, blames the build-out of fulfillment centers, which started before he took over, and he's just wrong. The fact is that if they want to be massively profitable, they can be. I think his big mistake was getting rid of Dave Clark. I think the second big mistake is, I don't even know who it is, the head of HR. They don't pay people enough, and they're losing really good employees. So I think that the people who are looking at it now positively, and I'm one of them, say Jassy's going to figure it out or he's going to be gone, and they're going to turn the profit direction back to massively profitable. They can turn on the taps on profits anytime they feel like it, and when they do, the stock is going to work. Remember, it's trading at about 2/3 of its peak, so it's down a lot still.